Is there a king of dividend ETFs among us? One who can unite the divided dividend investor armies and bring peace to the land? No. That's a ridiculous statement. Every ETF has its pros and cons, and every investor has their own needs. But I did find an attractive option for investors like myself looking for a monthly paying, high-yield, tax-efficient ETF. Oh wait, there's more. The data suggests it's also not a dividend trap. I determined that this investment was right for me given my research, so I do have this in my own portfolio, and I'm going to share with you what I found. And by the way, I found some weird stuff that you're going to want to know about. If you appreciate the transparency, tap that like button. Remember, I'm not a financial advisor and this isn't financial advice, but I will present to you SPYI so you can make an informed decision for your investments. As always, let me know what I got right, what I got wrong, and what I missed in the comment section down below. Let's get into it. This is the NEOS S&P 500 High Income ETF, and it's offering a 12% yield with a monthly distribution, which means investors are getting 1% in dividends every single month. That's way more than most savings accounts. The fund has been around since August 30th of 2022, and since inception, the fund has been paying out between 46 and 50 cents a month per share, and it has an expense ratio of 0.68%. So we've established that it has a high yield and pays monthly. That's great. However, you probably noticed a flood of new income-oriented ETFs hitting the market, each with their own unique strategy. When a high-yield income ETF pops up on my radar, I'm always on alert for a dividend trap. Or when a stock or ETF is paying a high yield, but the overall value of the investment is actually going down. This is a situation I want to avoid at all costs, since I'm trying to actually make money, not just see dividends hit my account. Now, to be clear, I'm okay with my investments losing value, so long as it's in line with what's happening in the overall markets. Since nothing goes up always forever, there are downswings. Looking at you, Bitcoin. What I think we're all trying to avoid is unsustainable dividends that are paid out from the fund's cash on hand, which is basically just giving investors their own money back. I'm looking for a sustainable income source, and I'm okay if that means if it's not the highest yield available. Every ETF is a little different in how they're structured and their strategy, so the best way to see if SPYI is a dividend trap, given its limited history, is to understand how it works and compare it against something similar. SPYI seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. That's right from their website. Continuing from the website, it also seeks to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. The fund utilizes a call option strategy that may include both sold and purchased SPX index options, which may provide the opportunity for upside capture in rising equity markets. All right, so let's break that down in plain English. The key takeaways for SPYI is that it sells call options on the S&P 500 index, not the underlying stocks themselves. This allows for more favorable tax treatment for trades. And when market conditions allow, the fund can buy and sell SPX index options to help capture more upside, although it hasn't gotten a chance to since the market hasn't actually been rising dramatically since inception. As far as the strategy is concerned, the fund sells out of the money covered calls, and it holds the underlying stock positions so it can capitalize on some upside growth as well. Top holdings are Apple, Microsoft, Amazon, Nvidia, Google, Meta, Tesla, Berkshire Hathaway, and United Health Group. Comparing SPYI to something that tracks the S&P 500 like VOO, we can see that returns were in line for what was expected for the year. But since this is an income-oriented investment, I wanted to know what the returns would look like without reinvesting the dividends, and I'm happy to report that for this year, the principal was not only maintained, but did see a small increase. So for the year 2023 so far, this ETF is not a dividend trap. Now, don't be like me and rush to your brokerage and buy it. Be better than me and be aware of the downsides first, because we want to make an informed decision. SPYI has a short history and as a result has extremely limited market data for us to use to make investment decisions. As time goes on, this won't be as much of an issue, but this is something to be aware of. In addition, by nature of using covered calls, the fund has limited upside, and it's exposed 100% to the downside, which likely means slower recovery compared to the overall market and a lower growth in comparison. So if you're looking for max returns, this ETF isn't for you. But remember the weird stuff I found? Well, First, why is the dividend so consistent? This is an income ETF, and I wouldn't expect the income to be basically the same every month given that options contracts change prices. That definitely sets off alarm bells for me personally. It turns out this might be intentional as the fund may be prioritizing consistent income versus growth. Nothing wrong with that, but if you're like me and dug a little deeper, you would have noticed that SPYI is paying out a ton of return of capital, which on the surface is a huge red flag. In the case of this ETF, this is a special situation. The fund isn't necessarily short on cash and paying out funds to maintain a payout, but rather they are distributing a combination of covered call income and dividends, and it's paid out as return of capital. Remember, this fund uses 1256 contracts from selling options on an index, not the underlying stock itself, and it's reported as a return of capital. So this is normal for this fund, and for now isn't a huge concern, but it's something to watch out for as we monitor our investments in the future, and might make it a little more difficult to see if the fund strategy is doing well or not. Since I have no idea how this or any investment will perform in the future, I have to remember that a return of capital that's reported needs to be looked into further for this ETF. Investors should also know that the fund will increase or decrease how far out of the money options contracts are written for. So further out, there would be less income, but possibly greater growth, and they will also adjust how much of the portfolio is used for options, which could mean higher income, so the fund has some wiggle room to work with to help generate income. Personally, I'm okay with this since I'm not the options expert, and I'm happy to outsource this to the fund managers. And a quick note comparing SPYI to other covered call ETFs like JEPI and XYLD. Compared to SPYI, I would expect it to have more upside than XYLD because XYLD uses 100% of the portfolio for its option strategy, and compared to JEPI, SPYI has more holdings, but JEPI's holdings are selected for lower volatility and also uses ELNs. So there's a lot of options out there and each have their pros and cons, but before we wrap up this video, I want to talk to you for a second about taxes and why tax efficiency for our investments is so important for two main reasons. This is where SPYI really shines. It doesn't matter if you're investing in a traditional account, 401k, or a Roth. Your money is still being taxed at some point in the process, whether that's before the money is invested like a Roth, while you're making money buying and selling and collecting dividends in a traditional account, or after you're pulling funds out of the account like in your 401k. It's unavoidable. So that's just one reason. The other reason is honestly really concerning that isn't talked about more. Taxes are one of our biggest expenses. Imagine you're making a $100,000 salary as a regular W-2 employee. Here in the United States, we have a progressive tax, which means the more you make, the more you pay in taxes. And there are marginal tax brackets, which means at every tax bracket, your dollars are taxed at different levels. So if you're a single individual and make $100,000 in a single year, you take your standard deduction. In 2023, that's $13,850. That means that money is not taxable income, so you keep 100% of that standard deduction. So now you have $86,150 of taxable income. And according to the 2023 tax bracket, you'll end up paying $1,100 for your first $11,000 taxable dollars. You'll end up paying another $4,047 for your next $33,725 taxable dollars, and you'll end up then paying another $9,113.50 for your remaining $41,425 in taxable income. So in our example, yes, you made $100K, but you also paid $14,260.50 in taxes. So 14% of your income is spent before it even hits your bank account. They take it before you even have a chance to spend it. Nice move. And that's just federal income. So if you live in a state that has a state income tax, you're paying even more. Taxes are one of our biggest expenses, and because they get taken out before the money hits our bank account, it can almost seem invisible. When it comes to dividends, those are usually taxed in some way, and for my dividends in my Robinhood account, taxes are not typically taken out before they're paid. So if you're dividend investing and using a traditional Robinhood account or something similar, make sure you know your tax burden because not paying or paying late will incur huge fines. Now, it's true, this issue of taxes is mitigated if you invest in a Roth IRA where your investments grow tax-free, but there are yearly limitations on how much you can invest into these accounts, so tax efficiency will eventually be on your radar as you increase your income and increase the amount you invest. It's also true that there are investments that pay high yields, and some investors are interested in making the maximum amount and are perfectly okay with paying those taxes. That's totally fine too, but some investors might be more tax conscious like myself, since dividends, especially from high yield investments, can compound quickly and add up to larger and larger tax bills. So something like SPYI might be a good fit for certain investors. As always, let me know your thoughts down below. Like this video if you found value in it. Feel free to subscribe for more content. And of course, good luck in the markets.